Good morning. This is the zero DTE morning analysis, and it is, as I always have to look to the right, even though I know it is Tuesday. It is Tuesday, December 3rd, 2024. And we're going to focus a little bit on what I call ZombieLand. So when I refer to ZombieLand, I'm referring to the volatility regime that we're currently in. I like to break up the VIX and the level of the VIX into what I call various volatility regimes so that we can get a good handle on what is the overall sentiment of the market. And the reason why we do this is that that has a direct effect on the pricing of options. The way it affects it is in the rate of time premium decay. And the way it works is like this. As volatility rises, that has a tendency to delay the premium decay on an option. And the reason for that, or another way to say it, and this may sound a little counterintuitive, is delaying that premium decay. Another ways to look at it is that it is actually inflating the value of an option. And the reason for that is that as price is experiencing this higher volatility, the range of price is increasing. And from the market's perspective, that is giving most options, a higher probability of achieving intrinsic value. So it's inflating the value of that option. As volatility lowers and drops, that rate of decay starts increasing. So in other words, the time premium is quickly diminishing out of an option because price range is decreasing, and from a market's perspective, that is minimizing or decreasing or decrementing the probability that an option is going to achieve its intrinsic value or its strike price. Just keep in mind that options, only 10% of them actually achieve their intrinsic value. That's why 90% of all long options expire worthless. And so volatility has a tremendous effect on the extrinsic value of that option, the time value. Now, almost everything that we do here in zero DTE strategies is focused around the volatility level, both big picture, which we look at the VIX and the volatility regime, and then the relative volatility to that for that specific day. The big picture volatility will allow us to determine what range of widths that we're going to use in our butterfly trades, our out-of-the-money butterflies, as well as other butterfly trades. And the reason for that is that when volatility is very high and we have that delay in the the delay in the premium decay, it actually creates a situation where the butterfly is sitting way higher on the profit and loss diagram, showing that there's much more potential profit in there and much less risk. And the gamma risk is also flatter, and so we can put on much wider flies. When volatility starts dropping and the premium decay increases, that actually increases the total value of the butterfly, so that when you get on that last day, there's much less profit potential, and the risk is much greater, and the gamma risk is much greater as well. In other words, the sensitivity to price is much greater. So that's a more risky situation, so we have to choose narrower flies. So watching the VIX and where it is essential in us producing the best possible risk-adjusted trade. So low volatility, we call it ZombieLand. When it gets down below a certain level, we have to act in certain ways, and it might also trigger various types of what I call edge case strategies as well to compensate for that. Sometimes the single out-of-the-money butterfly, it works in all conditions, whether it's very low or very high volatility. We just adjust its width. But sometimes there are times when you get to extremes where other strategies start coming into place. when you get really, really low on the volatility scale, we start losing our price advantage and our premium advantage. And when that happens, it makes a little bit more sense to go maybe another day out in order to recapture that accelerated premium decay. So going back to the second day where some of that premium might have been still available in higher levels of volatility on that last day. And also for the decreased price movement, because lower volatility basically means lower range in pricing. So what I've done is I've mapped out volatility and the average width range that we should be looking at, and you'll see it every morning when I do the my morning market analysis. In the hold on, let me get to it. In my chart here, you'll see I have the VIX, and I've split it up into 3 different sections. You can very plainly see I split it up into what I call ZombieLand, Goldilocks, and Chaos. And if you notice that the vast majority of time, over a long period of time, we are in the Goldilocks zone, which I've marked off between a VIX level of 17 and 32. And anything below 17, we start getting into what I call ZombieLand. And it's just like that, you know? ZombieLand is this area that you feel like you're being chased by zombies and you're running through mud, right? And that's what trading in that kind of VIX level feels like. And for that reason, we need to go for much narrower widths. You'll see over here on the left, I've shown the width guide for our out-of-the-money flies and how it increases as volatility increases. And then there are edge case strategies like Time Warp and Batman. Time Warp is all about the amount of time that we give our premium decay. So most of the time we're doing a 0 DTE trade, and as you can see, we can do 0 DTE through all ranges or all VIX regimes, volatility regimes. But when we get very, very low, like we are now at 13.32, and we can go lower than this, a 1 DTE or a 2 DTE trade starts becoming a little bit more attractive. So in other words, going 1 day out or 2 days out might be a better option, or at least an option. And then when we get into very high levels of volatility, maybe in the upper levels of Goldilocks zone or Chaos, we can start looking at Batmans, which are a trade where we put an out-of-the-money butterfly both above and below the market, and push them out into even higher out-of-the-money situations and lower risk to reward, or higher risk to reward, or what I should say is a ratio that is up to 1 to 12, 1 to 15 on each side of the trade, as opposed to 1 to 9. And then we put them on both sides of the market, and then that becomes another edge case trade in higher levels of volatility. So that's basically how we manage volatility and the different types of edge case trades that we can do. We do, of course, have another trade that we put on prior to the market opening called the Big Ass Fly. And that is also an edge case trade that is made with localized volatility when the IV is at a heightened amount. And that can be heightened regardless of what volatility regime that we're in, but it tends to happen more when we're in the Goldilocks zone. It can happen in ZombieLand as well. So there you go. That's the entire focus. And I said I wanted to focus on ZombieLand and why we trade the way we do in this type of volatility regime, and how we differentiate between ZombieLand, Goldilocks, and Chaos. So I like to use cute names like this because it's easier to convey that with our members and all the coaching clients that I have, so that when I'm talking about ZombieLand, everyone knows what I'm talking about. It just means that, hey, we got to be a little bit more patient. We have to be a little bit more reserved, bring our position size down, take less risk because the risks are higher. All right, so there you go. So now we know how VIX and ZombieLand affect our everyday trades. So every morning I'm looking at three basic criteria. I'm looking at the VIX, VIX regime that we're in, so that we can decide how wide we're going to go that day. We're also looking at price direction, so let's take a look at that right now. And we can look at that on a simple moving average and see where we are. And I'm using the Hull moving average with a 21-day period. And the way I do it is I look, am I above the average or am I below the average? If I'm above, then we're going to go with a call fly or an out-of-the-money call fly. If we're below the average, then it would be bearish, and we would go with an out-of-the-money put fly. The other way that you can look at this, instead of going above or below, is just look at the slope of the moving average. And that's why I like using the Hull suite in TradingView, because it has this beautiful ribbon here that makes it very easy to tell whether or not you're going up or down based on the slope. So if it's pointing up, then you can go with the call fly, and pointing down, you can go with the put fly. Excuse me. So those are two different methodologies. Neither is better than the other. They just provide a slightly different characteristic in the way that one's faster than the other, and one has more false positives. So in the long run, they both end up being about the same. And there are many other ways that you can choose price direction and figure out where the trend is going, but it is important that we always trade with the trend. All right, and as you can see, as we're getting up here, we're in nosebleed territory, and so that means that our third directive, and that is figuring out where our entry levels are, where our entry event might be. And those are where there are support and resistance levels that are determined by the volume profile or the market structure. And so I'm going to zoom in here. So here's the profile. This is a big picture profile. But as you can see, I have it all marked up with these horizontal lines. Excuse me one second. I have it marked up with these horizontal lines showing the inflection points or levels that have significance. As I zoom in on this, we can start looking at that. Let's go to a 5-minute chart. Once I've marked it up, there's not a lot of need to have the levels themselves or the volume profile in here. So that was yesterday's. And what we do is we only trade these out-of-the-money flies between the open, which is at 9:30, and that's why I'm drawing this vertical line, and the close of the afternoon session, which is at 12:30. We choose those times because, going back to the VIX, those are the times where volatility, or the implied volatility for that day, is at its peak. And so what we're doing is we're looking for a pullback to one of those levels. Now we're on all-time highs, so I guess really the only evidence that we have is this this new level that was put up here. So I could even mark that up and say, okay, there's a definite delineation right about here, and of course at the all-time high. So we can say, okay, here are our landing zones or potential places where we might see a trading event. One might be here if we get a pullback to here, right? And or a pullback to about here, which was drawn in the bigger picture, or down to here. So I'll just move that down to this guy here. So essentially, these are levels in the volume profile or market structure that have been marked up, that have been identified as areas where you'll see strong support or resistance. When we're at all-time highs, this becomes a little bit fuzzier because the profile and the market structure are not mature. We're really in nosebleed territory. We're in very high volatility, very ethereal, very loose market structure. But it still exists, so we still pay attention to it. So we're looking for a pullback, maybe something like this, right? And so if we get an event where price pulls back to here, or up to this one up here, we'll then put on an out of the money fly. In our case, it would be a out of the money call fly, and that means needs to be put up here somewhere, right? So we would expect that price would come down here. We would place the trade, and then it would bounce off of that support and then move up. All right, so that's essentially our strategy in a nutshell. Of course, there's a lot more to it, but that's where we are. So we have call flies on board today, out of the money call flies. We can look at a time warp strategy where we go multi-day DTE. We can consider 0, 1, or 2. So that means that we might put on a trade for Wednesday or Thursday and Friday. Well, Friday might be a little bit far out, but Wednesday or Thursday would be appropriate. And we're waiting for that event to happen where it comes down and where it interacts with a market structural level, and then we'll place the trade. So that's it. There you go. That's how we trade here. I'll do this every morning. If you are interested in learning more about this strategy and how to become a professional trader or trade at a professional level, become consistently profitable, manage that your drawdowns, your risk, trade with asymmetric positions, become consistently profitable, learn how to be an independent trader, then go to the link below and check out our community where you can learn all those things. So, it's been nice talking to you. We'll see you tomorrow. Coach Ernie out.